A Goldman Sachs financial assessment this week says Asian emerging markets will experience rather limited direct financial exposure from a Greek default on international loans and exit from the Eurozone. Most Asian countries own a small percentage of European debt compared to their gross domestic product and are prepared for some instability in financial markets.
They have a very large foreign exchange reserves, so whatever the financial shock waves that go around are not going to hit this place that much.
But Asian nations still depend on exports to Europe and America, and the region's major economies are currently in vulnerable situations. The recent sudden drop in China's stock market and reports of slow growth indicate the world's second largest economy may be struggling. A slowdown in China would significantly affect the region.
If China's transition is not smooth, then obviously other economies will be hit pretty hard. Most countries, for most Asian countries, China is the largest trading partner, right? So if Chinese demand weakens, it will be a big impact.
At the same time, South Korea's economy is trying to recover from a downturn in tourism and domestic spending following an outbreak of the Middle East respiratory syndrome. And while Japan has been experiencing relatively strong growth recently, it is still recovering from last year's recession. Currently, Goldman Sachs is projecting a limited fallout from a Greek default with a less than 2% decline in exports. But a significant contraction in the European economy could stagnate global trade, weakening demand for the exports that are key to Asia's growth. Brian Padden, VOA News, Seoul.